Every year, our tax firm, Fahmy, prepares about 1,300 to 1,400 tax returns. And what I've personally noticed is that these 22 or 23 tax forms are incorporated in 90% of returns that are prepared every year by our firm. And I would expect that statistic to actually apply to all returns that are filed every year in America. So what my goal here is to educate you guys on the basis of each of these forms, where they go in the tax return, and how to read them. And that will help you file your taxes more accurately and just become more educated overall on tax filings. The most common tax form is Form W-2. Any individual that works for a company as an employee is going to get this tax form, hopefully by January 31st, after the year that you've earned this income. Box A is going to have your Social Security number. Make sure that this matches your true Social Security number. Otherwise, if you file your taxes and this does not match, you will get a lot of notices from the IRS, from the Social Security Administration, from the state. If your state has state income tax, it's going to be a massive pain to deal with. So it's very important that the Social Security number on your W-2 matches your true Social Security number. B and C is very basic. That's going to be your company's federal tax ID as well as their name and address. Box E and F will be your name and your address. Box 1 is your income subject to federal income tax. Box 2 is going to be how much federal income tax you withheld during the year from your paycheck. Box 3 is not Social Security income, it's wages subject to Social Security taxes. And then box 4 is the Social Security tax withheld. Theoretically, income above $147,000 is not subject to Social Security taxes, and the Social Security tax rate is 6.2%. Box 5 is your wages or income subject to Medicare taxes, and box 6 is your actual Medicare tax withheld. If you work in the restaurant industry, you're going to have a figure in box 7 and box 8 for tips earned as a restaurant worker. Box 10 is money given to you by your employer for dependent care benefits. And if this money is not filed properly on Form 2441, it does become taxable. However, if you are given dependent care benefits and you're spending it properly on a daycare or a nanny or some other organization to care for your kids, this figure does not become taxable to you. Box 12 we're going to see in our next slide, and box 14 will be the slide following that as well. And then box 15 is going to have state information. So you're going to have your employer's state tax ID number, the wages that are subject to state income tax. Box 17 is the state income tax withheld. Another important note to keep in mind is if you're moving states, you should have either multiple W-2s or you should have more rows, because you want to make sure that you're reporting the income in all the states that you are subject to income tax in. These are the most common box 12 codes on Form W-2. Code C is for the taxable cost of group term life insurance over $50,000. Codes D through H are elective deferrals to a retirement account. So for example, if you're taking part of your paycheck every year and you're putting that towards a 401k or a 403b, that will be reported in codes D through H in box 12 on your W-2. Code V is income related to the exercise of a non-statutory stock option, generally through your employer. Box W is for employer contributions into an HSA account. An HSA is a health savings account. Codes AA, BB, and EE are related to employer contributions into a Roth account. Codes DD are health insurance premiums paid for by your employer. Here are some common box 14 codes on your W-2. Number 1 is clergy parsonage allowance and utilities. This is of course applicable to clergy members that are working under a church. Number 2 is charitable contributions through payroll deductions. Now what this is money that you're taking out of your paycheck through your employer and you're contributing it to a qualified nonprofit organization. Number 3 is educational assistance. For example, money that you get from your employer to go to college. Number 4 is health insurance premium deductions. Now this is different from box 12 code DD. Code DD in box 12 is related to employer contributions to a health insurance plan, whereas box 14, this is going to be related to health insurance deductions from your paycheck. So you're actually paying this through your W-2 earnings. Number 5 is non-taxable income. Number 6 is state disability insurance withheld, if applicable. And number 7 is union dues. If you earned interest during the year, you'll be getting a Form 1099 INT or 1099 interest form. That's going to be there to report any interest income that you received in that year or you accrued in that year. Box 1 is going to have your interest income subject to federal income tax. For example, if you have interest from a checking account or a savings account or a CD, that's going to be reported here. If you had money in a CD, for example, and you took the money out before the period ended, that penalty is going to be reported in Box 2. Box 3 is going to be interest on any U.S. savings bonds and treasury obligations. For example, if you purchased a 6-month T-bill that was paying 4%, that related interest income will be in Box 3, and as a fun fact, that is not taxable at the state level. Box 4 is going to have any federal income tax withheld that your financial institution withheld on your interest income. So this is good to report on your taxes because it's going to be a tax credit on your return. Any investment expenses will be in Box 5. If you earned any interest income in a foreign country, that's going to be in Box 6. And the reason why this is important is because you don't want to pay US taxes and foreign taxes because that would be double taxation. So generally what you can do is you can pay the foreign taxes on the interest income from that foreign country and get a tax credit for it on your US tax return. Box 8 is for tax exempt interest. Again, if you recall my last video, even if the interest is not taxable, you still have to report on your taxes, and that's going to go in Box 8. And the rest of these generally are not going to apply to the average person, so we won't do a deep dive. If you've been paid out dividends during the year, you'll be getting a Form 1099-DIV or 1099 dividend form. This is there to report any dividend income to the IRS and on your taxes. Box 1A is going to have your total ordinary dividends. Box 1B is going to have your qualified dividends. Qualified dividends are taxed at a much lower rate than total ordinary dividends. Keep in mind that if you've invested in a company for a year or more, and that company then issues you dividends, you'll be paying the qualified rate, which is generally the capital gains rate. If you've held that company for less than a year, then you'll be paying the ordinary dividend tax rate, which is just your ordinary income tax rate. So you can see that it's better to hold a company for more than a year and you'll be paying less taxes on those related dividends. A lot of these are not really relevant to the average person, so we're going to skip them, but capital gain distributions would be reported in 2A. If there's a non-taxable section 1202 gain, that would be reported here. It's not taxable, but it has to be reported on your taxes. Box number 3 is related to non-dividend distributions. And then box 4 is related to federal income taxes withheld. So if your financial brokerage or financial institution is withholding federal income taxes from dividend earnings, that's going to be reported on box 4 and you'll get a tax credit for it when you file your taxes. Box 5 is generally for dividends related to a Section 199A company, and this is usually for small businesses. Box 6 is related to investment expenses, pretty self-explanatory. Box 7 is for foreign taxes paid on those dividends. For example, if you're invested in a company that is subject to foreign taxes on the dividends, you should be getting that report on box 7 and getting a foreign tax credit for it in the same way that we're discussing for interest income. Anytime someone is selling capital assets, they're going to get a 1099-B form. And this only applies if you actually sell the security. If you're just buying a bunch of stocks, you will not get a 1099-B form. The key here is you have to actually have sold because that's going to cause a taxable event. And that taxable event is going to be reported on Form 1099-B, which is going to flow into most likely Form 8949. And then it's going to flow into Schedule D. And then, of course, Schedule D is going to flow on Form 1040, and that's where you're going to be paying capital gains tax or ordinary tax, depending on how long you have the security for. So let's just take a very simple example. Let's say I bought 1 share of Apple stock for $1, and I sold it for $100. So description of property, box 1A, I'm just going to put 1 share of Apple stock. That's what's being sold. I'm going to put the date that I bought it in box 1B. I'm going to put the date that I sold it in box 1C. Box 1D, I'm going to put the price that I sold the Apple stock for. So in this case, $100. I'm going to put that I bought it for $1 in box 1E. Box 1F is not really going to apply to the average person, so we can skip that. Box 1G is going to apply to wash loss sales. And what this means is if I were to have sold Apple stock for, let's say, a loss, for example, I bought it for $1, sold it for $100, I would have a $99 loss. And then if within 30 days I buy Apple stock again, those wash loss sales, the $99 would generally be disallowed. And that's what a wash loss disallowance is. Now, one hack that people are talking about on Instagram and social media and all over Facebook and YouTube is tax loss harvesting, and that really applies to cryptocurrencies. So if you sell Bitcoin at a $10,000 loss and you rebuy it the next day, they are not subject to wash loss rules. So keep that in mind. Box 2 is going to correspond to if the sale was short-term or long-term. If I bought Apple stock and sold it within 1 year, that's short-term. If I bought Apple stock and sold it after more than a year, that's long-term. I'm going to be paying a lower capital gains rate on that sale or gain. Box 3 corresponds to sales related to collectibles or qualified opportunity funds, but we don't have to worry about that because most people are not going to be invested in one of these two asset classes. Box 4 is going to relate to federal income tax withheld. Box 5 we can skip. Box 6 we can skip. Doesn't really apply to the average person. If there's another reason why a loss is going to be disallowed, then box 7 would be checked, and you'd have to report that as a non-deductible loss on your taxes. And then 8 to 11 is for more complex securities and derivatives, but we don't have to worry about these for now. Any state taxes withheld, again, just like the interest and dividends, that's going to be reported on boxes 14 through 16. Anytime money is pulled out of a retirement account or you're converting one retirement account to another retirement account, you'll be getting this form 1099-R. Box 1 is going to report your gross distribution or the amount that you're rolling over. If there's a taxable component, for example, let's say you're converting a traditional IRA to a Roth IRA through a backdoor Roth conversion, or you're simply just pulling money out of your 401k account, that amount will go into box 2A as your taxable amount. Sometimes you'll see box 2B checked, and that just says taxable amount not determined. Sometimes the financial institution that's holding your retirement account does not know if the transaction will be taxable, in which case they'll just have this box checked, but you don't have to worry about this. You just have to worry and make sure that your retirement distribution or rollover is accurately reported and taxed if applicable. If you fully liquidate the account, for example, you have $200,000 in your 401k and you pull out the whole $200,000, you'll see this total distribution box checked. If there's any capital gains involved here, then that amount will be reported in box 3, and then any retirement distributions are generally going to have a withholding of about 20%, and that will be in box 4. If your distribution contained any kind of employee contributions or designated Roth contributions, that's going to be in box 5. Box 6 is going to be related to net unrealized appreciation in employer securities. And the typical example in this, or of this I should say, is let's say I'm working for ExxonMobil. In my retirement account, I have ExxonMobil stock that's appreciated over the years. So that's what's going to be reported in box 6. And then box 7 has your distribution codes. These are the most common ones. Number 1 is early distributions, which don't have an exception from the early withdrawal penalty. So if I have a 401k account and I pull in $50,000 from it and I'm 35, for example, I'm going to be paying a 10% early withdrawal penalty, and that's going to be reported under distribution code 1. If I do have an early withdrawal penalty exemption, then I'm going to see number 2 under box 7. If the money I'm pulling out for is related to disability or death, then I'll have codes 3 or 4. If I'm taking out a distribution and I've already reached the retirement age of 59.5, then that will be number 7, and I will not be paying the 10% early withdrawal penalty. If there's a non-taxable rollover, for example, I'm rolling over a 401k to a traditional IRA or a 401k to another 401k account, that's going to be code G. If I take a loan out of a 401k account and I never pay it back, that might be treated as a distribution, and that will be code L. There's other codes, but most of the time I really don't see them in my practice, so there's no point in talking about them as they won't apply to the average person. And then, of course, if there's any state taxes withheld, you'll see 14, 15, 16 filled out. If you're getting Social Security income from the Social Security Administration, then after the end of the year, you'll be getting a Form SSA 1099, and that's your Social Security benefit statement. The whole purpose of this form is just to show what your financial benefits are, as well as if you're electing to have your Medicare premiums deducted from your benefit amount, that's going to be very important. The important thing here to note is that if your AGI, or adjusted gross income, plus tax-exempt interest income, plus 50% of your Social Security benefits is $32,000 or more for married filers, or $25,000 or more for single filers, then your Social Security benefits will be taxable. Health insurance premium figures are also very important because if you're itemizing on your taxes and your total medical expenses are more than 7.5% of your adjusted gross income, these Medicare premiums will offer a tax benefit for you. Otherwise, if you're doing a standard deduction, then this figure is not really going to do anything for you. If you've had debt canceled, the most common example is you negotiate with your credit card company, such as Capital One or American Express, and they decide to forgive your loan or to forgive your debt. Most likely you'll be getting a Form 1099-C after the end of the year, and that's going to report the amount of debt that was discharged, and that will be taxable to you. In certain cases, you can file Form 982 on your taxes, and if you're insolvent or you filed for bankruptcy, that amount will not be taxable to you, but you will have to report it properly on Form 982. If you are a shareholder of an S corporation, or if you're a partner in a partnership, or a beneficiary of a trust or estate, you'll be getting a Form K1 at the end of the year. Now, as you can see, this is the one for S Corps, this is the one for partnerships, and this is the one for trusts. You'll notice that they're all fairly similar. And just to kind of give you a quick summary of each one, this is going to show your income information. For example, ordinary income or rental income, interest, dividends, capital gains or losses. It's going to also have Section 179 deductions or other deductions that might be applicable on your personal tax return, as well as any tax credits that you're entitled to. And it's also going to include AMT items. For example, if there's income that you received, it might be taxed one way for ordinary income tax purposes and then another way for AMT purposes. It's also going to include any items affecting shareholder basis, for example, any capital contributions or distributions, or if there's any other information needed to compute a particular deduction or tax credit, that's going to be reported under other information. You'll see that the K1 for partnerships is pretty much the same. One of the key differences, though, is guaranteed payments for partners, and that's in box 4. This here is unique to partnerships and is not applicable for S corporations or trusts. And then you'll see that the one for trusts is fairly similar to these two, except there's no business income, and that's because trusts are not businesses, therefore there's no business income. And again, these forms are here to show your share of the income that needs to be reported on your taxes, or your share of the deductions or tax credits that need to be reported on your taxes. If you're having a good year and you've made some money on the slot machines or playing blackjack or poker or betting on horses, then you'll be getting a W-2G, and that's going to report your gambling earnings or gambling income. So that's going to go in box 1. The date that you won that money is going to be in box 2. Then this will be more information on the actual type of bet or type of gambling that you've done. And then box 4 and box 15, that is going to show any federal and state income tax withholdings. If you lost money gambling, that can be taken as an itemized deduction against your gambling earnings. Unfortunately, let's just say you went and played some craps and you spent $2,000 and lost it all. If you don't have any gambling earnings to offset it, then you will not get any benefit from those gambling losses, number 1. Number 2, even if you have gambling losses that can offset your gambling earnings, you cannot take those gambling losses as a tax deduction unless you're itemizing on your taxes. So if your total itemized deductions are, let's say, $15,000, but you're married and the standard deduction is around $25,000, you're going to have to take the standard deduction because it's more tax advantageous to do so, and all those gambling losses that you have are not going to be usable. If you provided services as an independent contractor, not as an employee, then your earnings will be reported on Form 1099 NEC, specifically on box 1. And if there are any federal income tax withholdings or state income tax withholdings, they'll be reported on box 4 and 5 respectively. For all other income that you've earned during the year, if it's not encapsulated in the other forms that we just discussed, you'll be getting a 1099 miscellaneous. For example, rents would go on box 1, royalties would go in box 2, other income that's not one of these would go in box 3. Box 4 is going to have any federal income tax withheld on that miscellaneous income. If you're a doctor, a dentist, or other healthcare provider, those payments that you receive will go in box 6. If you're an attorney, amounts paid to you will be reported in box 10. The rest of these are not really applicable, and then box 16, 17, and 18 are the same thing as the previous ones, which is state income and state income tax withheld. on your 1099 proceeds. If you are a small business owner and you process credit card transactions, for example, Visa, MasterCard, Discover, American Express, or you're a small business owner, you make sales on Shopify, or you accept PayPal, these companies will give you a Form 1099-K, and that's just there to report your gross proceeds from credit card or third-party network transactions. When an individual sells real estate, for example, a primary residence that they expect to owe capital gains tax on, or an investment property, for example, a rental or a real estate property being used for VRBO or Airbnb, they'll be getting a 1099-S form that specifically reports the date of the sale and the gross proceeds, the address of the property, and that'll be used to compute any kind of capital gains or depreciation recapture. Anytime an individual takes money out of an HSA account, they will be getting a 1099-SA form. Now keep in mind that when you take money out of an HSA account, if you do not use it for qualified medical expenses, that money will be taxable to you. Otherwise, if you use it for qualified medical expenses, you'll report this as income on Schedule 1, and you'll also be getting a deduction for the medical expenses. Therefore, it will not be taxable to you. Form 1099-G is to report certain government payments. The three most common government payments I see is unemployment compensation. So if your state paid you unemployment compensation, that'll be reported in Box 1 and it's taxable. This will end up on Schedule 1. If you itemized on your taxes and you get a state refund, it may be taxable, and that amount will be reported in Box 2. If you received a taxable grant from your state or locality, for example, let's say that you're in, then that taxable grant will be in Box 6. Everyone that has health insurance in the United States must receive a 1095-A or 1095-B. If the health insurance is purchased under the marketplace, for example, in California, if you buy your health insurance from Covered California, you will be getting a 1095-A form. Now, if you file your 1040 without this form and you were issued one, the IRS will not process your return and it will cause delays in your refund processing and your overall tax filing processing. So it's very important that if you have health insurance through the marketplace, you get a copy of this form and you properly file Form A962 so that your premium tax credit is properly calculated, or maybe you might have to pay some of it back if you got too much subsidies from the government. For everybody else that has health insurance through their employer or that they're privately paying for out of pocket, they'll be getting Form 1095-B. If you've paid student loan interest during the year, your lender will give you a Form 1098-E that shows specifically how much student loan interest you've paid, not the principal, specifically the interest, because that might be tax deductible for you. Keep in mind that if your income is below these thresholds, the max deduction you can take is $2,500. If your modified adjusted gross income is more than $85,000 for single filers or $170,000 for married filers, no deduction is allowed. This is going to piss off most attorneys, most dentists, most doctors that went to medical school or dental school and they owe $300,000, $400,000 of student loan debt. Finally, they finish residency or training for their professions and they're making over $300,000. Those people will not be able to deduct any student loan interest. It's quite the bummer, but this is the government and they are trying to hold you guys back for some reason. I don't know why. And keep in mind that parents that pay for their children's student loans, they cannot deduct their kids' student loan interest on their taxes either. If you've paid tuition for yourself or for your child for an eligible academic institution, usually this is for undergrad or for grad school, you'll be getting a Form 1098-T from that academic institution, which shows you the total tuition and related expenses that you've paid. And this will help you calculate how much tuition and fee deduction are you eligible for, or maybe it's more advantageous for you to claim the American Opportunity Tax Credit or Lifetime Learning Credit. In general, just as a fun fact, if you're eligible for the American Opportunity Tax Credit, this is going to be a much more valuable tax credit for the Lifetime Learning Credit. It's usually after the 4 years of undergrad that you start to claim the Lifetime Learning Credit if you're still paying for tuition expenses after you've graduated. If you have a mortgage on a real estate property, whether it's your primary, secondary, or an investment property, you should make sure to request Form 1098-I from your lender, because that's going to report important information such as your mortgage interest paid, mortgage insurance premiums paid if applicable, any points that you've paid. And if you are impounding your property taxes with your mortgage, usually the Form 1098 is going to include a statement that has that information as well. Keep in mind that depending on when you got your primary residence, secondary residence, or investment property, as well as the mortgage itself, depending on the balances, if it's more than $750,000 if you got the loan after 2018, or $1 million if you got the loan prior to 2018, that's going to force you to prorate your mortgage interest down, unfortunately, when you take it as an itemized deduction. However, if this is for a rental property or a short-term vacation rental, for example, if you're doing an Airbnb or a VRBO, there's no caps for how much interest you can deduct. You can take the whole thing. So keep that in the back of your head. If you've contributed to an HSA or MSA during the year, you'll be getting a 5498 SA. This is not to be confused with a 1099 SA because 1099 SAs are for distributions or money being pulled out of the account, whereas 5498 is for contributions or money being put into the account. Box 2 is really going to put in how much you contributed during the year, and then box 6 is going to specify what type of account it is. Keep in mind that in order to deduct HSA contributions, you must have a high deductible health plan. So the health insurance plan that you have must have a deductible of more than $1,400 if you're single, or more than $2,200 if it's a family plan. And the reason why you'd want to put money into an HSA account and then use that money for qualified medical expenses, because this bypasses the 7.5% AGI floor on your itemized deductions. So for example, let's say in your 60s, you need a colonoscopy, it's going to cost you $5,000. If your income's $100,000, you have a 7.5% floor, meaning that the first 7.5% or $7,500 of medical expenses is not deductible. Whereas if you put this money first into an HSA account, you'll get a $5,000 tax deduction, and then you can use that money for that colonoscopy, and then it ultimately becomes tax deductible when you completely bypass this limitation. If you exercise an incentive stock option from your employer, you'll get Form 3921, which is going to help you or your accountant calculate what is your ordinary income tax, your capital gains tax, and any AMT taxes that correspond to that specific transaction. If you get stock through an ESPP plan, that's going to also help calculate ordinary income tax or capital gains tax related to those employer securities. So it's very important that when doing your taxes, if you have an ISO that you've exercised or an ESPP, you must get these two forms to provide to your accountant so that they can accurately calculate these figures for you. If you received the advanced child tax credit, you received an LTR 6419, and that just helps you reconcile how much credit did you receive, how much credit you're entitled to, and if there's any difference, that would be reported as a tax credit on your individual income tax return if you're eligible for it. So it's very important that if you receive the advanced child tax credit before you actually filed your taxes, that you give your accountant this form or you use this form to fill out Form 8812 on your taxes.